It ain't cool seeing your parents age. Yeah, they're our parents and they get on their nerves sometimes, but they're still our parents. And at one point, especially if you have great parents like us, you really looked up to them. They might have even been superheroes to you. So despite the ups and downs, it's really hard to see them slow down a bit. And as they age, there's a lot of things that us kids really have never thought about, and we might end up paying for that ignorance in the future. So here's one of the ways that my wife and I are planning to make sure our parents are taken care of. Let's go. Most people in the U.S. live to about 77 and a half years old, but they typically retire between 61 and 64. And those 13 to 16 years, most older adults really tend to slow down, especially if they retire and don't have anything else to put their energy and efforts towards. And if they do start to slow down, get sick, need mental help or physical support in those later years, us children might have to step in and find a way. So how are we preparing to this? The first thing I talked to my parents about several years ago is getting long-term care insurance. And I really encouraged them for several years. Now, long-term care insurance helps cover the costs associated with nursing home, home-based care, residential care, and adult daycare facilities. Pretty much anything that is needed for longer than 3 months. Some of us are a part of what they call the sandwich generation, meaning we have kids and parents that we have to take care of. Now, long-term care insurance goes a long way to giving peace of mind that we don't have to do it on our own because it will pay for helping our parents do daily activities like cooking, bathing, cleaning and getting dressed, and just moving around the house as they need to. Now, a lot of parents are just plain stubborn and they'll fight tooth and nail that they don't need it. They'll say things like, Jesus is going to take me in my sleep, or I'm healthy so I don't need that, or I'm never going to be in a nursing home because my kids better take care of me. Yeah. Yes, these are all statements that, as you can tell, we've heard before. Now, no one knows the future, and I have no way of knowing what care my parents might need. I would always try and make sure my parents are taken care of course, but the way many parents be acting, their kids might just end up leaving them in the streets. Plus, why would a parent want to burden their kids with taking care of them financially? I'm not talking about supporting them and making sure their services are on point and they're well taken care of. I mean the financial burden that comes with those things. Sure, if push comes to shove, I expect my kids to take care of me when I'm old as well, but I'm sure enough not going to plan for it to be that way. Over 56% of people 65 or older will need long-term care services. And on average, those people that use it will need almost $250K in expenses to cover. Would I ever want my kids to have to pay that amount of money? No. That's a big financial burden. Now, lucky for us, me and my sisters were able to convince my parents that they need this insurance. Now, this insurance can be expensive, so I wanted my parents to get insurance when they turned 60, so it'd be cheaper. My mistake was starting to talk to them about it when they turned 60, and it took several years to convince them. I really should have started talking to them about it a few years before they turned 60. And we completely missed my dad, and now he no longer qualifies because of his age and health. Even with my mom, because we didn't talk to her about it sooner, and because she got it a little late, it's more expensive than if she would have gotten it at 60. Now, there are 3 types of long-term care insurance that I considered when speaking to my parents. The first one is life insurance with long-term care. This is the first one I considered because this is the one my mom's financial advisor tried to sell her. Riders typically are offered by financial advisors who aren't licensed to sell long-term care insurance, so they're not true long-term care policies. Now, this type of policy is basically a whole life or universal insurance policy that includes a rider for long-term care. If you need long-term care, the cost of those services is just taken out of the death benefit of the policy. Most people like these because they have a guaranteed payout, and if you don't use the money for long-term care, your kids or other beneficiaries receive the death benefit. People also like it because your premiums are locked in for life. People like that certainty that premiums will never change. Now, I'm not a huge fan of these because they don't cover as much a lot of times, but also because they're just really expensive, usually between $5 to $10 grand a year for $300,000 in coverage, depending on your age. Most people will pay these large premiums because they don't usually feel the expense of the policy because their financial advisors can sell them to their clients without directly taking any money from them. They just take the premiums for the policies out of the client's retirement account that they're already managing. Their clients are much less likely to understand the real impact taking these large premiums out of their retirement accounts would have on the long-term growth of their retirement funds and their ability to withdraw that money from their retirement accounts to live off of. And when presented with these policies, their clients usually don't have anything to compare it to. They don't know what other policies are out there and how much they cost. That's why it was so important for me to shop around. Now, I'm not saying these policies are scams, but it just felt that way when it was being pitched to my mom. So I wanted to make sure we considered all of our options before moving forward. So that's when I started looking at the next option. But before we get into the next option, if you find this info helpful, then subscribe to the channel. We're trying to get to 1,000 subscribers, so we'd really appreciate it. Now, the next option is something called a hybrid plan. And a hybrid plan is basically a mix between long-term care insurance and life insurance. Almost 85% of all long-term care policies are this type. Now, it's very similar to a life insurance policy with a rider, but it's not the same thing. There are three main differences. The first one being that, like a life insurance policy with the long-term care rider, the premiums are set and can't be increased, but they don't last for life, and they usually end after a certain number of years, like 10 years, for example. The second difference is that it's a lot easier to get your money when you need it. Long-term care with a rider normally requires you to have more disability before you can file a claim. Some of them even require a permanent disability before you can get money. That's not the case with the hybrid plan. The third difference is that unlike life insurance with the rider, a hybrid plan offers inflation protection. So in today's dollars, if overall long-term care costs $250,000, in 18 years that same care might cost $450,000. So it's very important to have that inflation protection so that you can actually get your services paid for. Life insurance with long-term care rider doesn't have this option. The big thing I don't like about hybrid plans is that they're so expensive. When I shopped for my mom's plan, the monthly premium was double what it cost to get life insurance with the rider. Traditional long-term care insurance. Now I prefer traditional long-term care insurance because they're cheaper, usually half of the price for the same long-term care coverage. They usually cover more things, are more customizable to your needs and situation, and have some tax advantages with tax-deductible premiums. Like a hybrid plan, a traditional long-term care policy offers the ability to include inflation protection so you can make sure your expenses are covered in the future. Now, these aren't life insurance policies, so there is no death benefit, and if you don't need long-term care, you basically throw away all the premiums paid. But in my opinion, the $200,000 or $300,000 that you get in a hybrid plan isn't the best life insurance payout anyways for the premiums you're paying. And hopefully by retirement age, life insurance isn't needed anymore because there's enough saved in your retirement accounts to live off of. And this was the case for my parents. Between pension, 401k, and Social Security, my parents really didn't have any need for insurance because their kids are grown and self-sufficient, and if one of my parents died, the other could live off their retirement accounts. But anyways, a lot of people don't choose these traditional plans because the premiums aren't set for life. The benefit period is usually between 2 to 5 years, and after that, they can increase your premiums. They can't cancel your policy, but they can charge you more for it. Now, this is understandably scary for most people because there's uncertainty there. Over a 20-year period, most can expect anywhere between 2 to 5 premium increases of anywhere between 10 and 80%, depending on the state they live. Now, that's a lot of uncertainty. But what I didn't understand when I first researched these plans is that they can't just raise premiums for no reason. There are a lot of state regulations and oversight rules, and any premium increases have to be approved by the state. The insurance company has to provide a good justification before they're allowed to increase premiums. And they can't just increase it on any one individual. They can only increase it on a class of policyholders, like everyone with a particular feature. The best comparison I can think of is that this is sort of like your utilities. Your utilities can go up, but they have to get approval by the State Utility Commission before increasing rates. In the same way, insurance providers have to get approval from the state's Department of Insurance before they raise rates. So while it's more uncertain, it's no different than some of the other things that we all have to pay for. Now, one of the good things about the traditional plan and the hybrid plan, which is not offered by the life insurance with the rider, is something called state partnerships. This is basically an agreement with the state that if you hit your long-term care policy limits, you're able to go on to Medicaid to get the rest of your treatment. It even reduces the amount of money that Medicaid can go after to pay them back for care. Now, a lot of people don't realize that if you don't have this protection and you have a high cost of long-term care, that Medicaid can go after your assets to reimburse them for the cost of care, even so far as to coming and taking your house. So for example, if you have a long-term care policy with a $300,000 limit and you owe $600,000 in long-term care, Medicaid can only go after $300,000. So these partnerships with the state are very important. Now, these two options are by far the most common long-term care options. You have others, but they're usually not feasible for most people. You also have annuity policies with long-term care riders. Now, if you aren't familiar with what an annuity is, it's basically an agreement between you and the financial institution to get a consistent stream of income in the future in exchange for a large lump sum payment up front or monthly premiums paid over a certain amount of time. The problem with these is that most long-term care annuities require large upfront payments of anywhere between $50,000 to $100,000. And most people just can't do that. You also have short-term care insurance, but these usually only provide coverage for a year or less, which isn't usually enough. You also have group long-term care insurance, but very few companies offer this as a benefit to their employees, and so it's not an option for most people. So traditional long-term care insurance is the best option in my opinion. But this is just one opinion, so let me know in the comments what you guys are doing to prepare for your aging parents. Another way you can take care of your aging parents is to just build wealth. That way you can pay for anything that's needed in their retirement years. And if you want some tips on how to build wealth, check out this video right here.